Have you ever considered a long-time investment strategy? Have you heard of the concept of value investing? Do you want to know how to have a well-diversified portfolio? In today's video, we are going to talk about The Intelligent Investor, the book that will bring answers to those, and many other questions. Written by Benjamin Graham, this book is considered a must-read for anyone interested in investing, and is widely considered one of the best books on the subject. It advocates a value investing approach, and emphasizes the importance of having a long-term investment strategy. It also covers topics such as the role of the stock market, the dangers of speculative investing, and how to select investments with the potential to produce good returns over the long term. The timeless wisdom of The Intelligent Investor still shines bright, nearly 75 years after its initial publication in 1949. The book is structured in the following four main sections: Introduction, General Portfolio Policy, The Investor and Market Fluctuations, and The Investor and His Advisors. In this video, we are going to deep dive into the first two parts of the book. We will also go through some examples to illustrate these key principles presented by Graham. The first section we are covering in today's video is the introduction. This section provides an overview of the book, and explains why it is important to have a long-term investment strategy. Graham introduces the concept of Mr. Market, which is a metaphor for the stock market, and explains how to use it to your advantage. He also discusses the difference between investing and speculating, and the importance of being a defensive investor. Mr. Market is used by Graham to illustrate the idea that the market is irrational, and can be influenced by a variety of factors. Graham advises investors to view the market as a source of information, rather than a source of funds, and to take advantage of the market's fluctuations, by buying low and selling high. Graham also tells you to adopt a defensive approach to investing, which involves being cautious, and avoiding risky investments. It is important to have a long-term investment horizon, and to avoid the temptation to chase short-term gains. To understand the concept of Mr. Market, let's have a look at this illustration. Imagine that you own shares of a company, which you bought for $50 per share. One day, Mr. Market offers to buy your shares for $80 per share. You are pleased with this offer, and decide to sell. A few days later, Mr. Market offers to sell you the same shares back, for $40 per share. You decide to buy the shares back, knowing that you can sell them again for a profit once Mr. Market's mood changes. In this simple example, Mr. Market's irrational behavior represents the ups and downs of the stock market, and how it can fluctuate based on a variety of factors. By taking advantage of Mr. Market's mood swings, you are able to buy low and sell high, which is a key principle of value investing. In the introduction of the book, Graham also talks about the importance of adopting a defensive approach to investing. Let's have a look at this with an example. Imagine that you are considering investing in a biotech company that is developing a new drug. The company's stock price has been rising rapidly, due to excitement about the potential for the new drug, but there are also risks involved. For example, the drug may not be approved by regulatory agencies, or may not be as effective as hoped. Taking a defensive approach to investing in this situation might involve thoroughly researching the company and the drug. You can also consult with experts in the field, and carefully consider the risks and potential rewards of the investment. In addition, you can diversify your portfolio by investing in other companies and asset classes, other than the biotech company. And this concludes the first section of the book. The next section is about General Portfolio Policy, which discusses the importance of diversification and the role of the stock market. Graham explains the concept of the margin of safety, which is the difference between a stock's intrinsic value and its market price. He also covers the importance of having a well-diversified portfolio, and the role of the stock market in providing liquidity to investors. When investing, he says that you should look for stocks with a large margin of safety, as this can help protect your investments, in the event that the stock's intrinsic value is lower than its market price. He also advocates for a portfolio diversification approach, just so you spread your risk, and protect yourself against losses. Finally, Graham explains the role of the stock market in providing liquidity, which refers to the ability to easily buy and sell investments. Now, to illustrate the concept of margin of safety, let's look at this example. Imagine that you are considering investing in a particular company. You have done your analysis of the company's financials and other factors, and you believe it is worth $100 per share. The company's stock is currently trading at $80 per share, so, theoretically, there is a margin of safety of $20 per share. In this case, $20 would be the difference between the stock's intrinsic value and its market price, what Graham calls margin of safety. Based on this principle, you decide to invest in this company, knowing that you have a margin of safety of $20 per share. If the stock's intrinsic value turns out to be lower than you anticipated, the margin of safety will provide you with some protection against losses. For example, if the stock's intrinsic value is $90 per share, you will still have a $10 per share margin of safety. This means that you will not lose as much as you would have if the stock was trading at or above its intrinsic value. On the other hand, if the stock's intrinsic value is higher than you anticipated, you will potentially earn a higher return on your investment. Now, let's look at the concept of diversification of your portfolio. Imagine that you have $100,000 to invest, and you want to create a well-diversified portfolio. One way to do this might be to invest in a mix of stocks, bonds, and other asset classes. For example, you might allocate $40,000 to stocks, $30,000 to bonds, $20,000 to real estate, and $10,000 to cash. Within each asset class, you might further diversify by investing in a mix of different types of securities. For example, the $40,000 allocated to stocks might be invested in a mix of large cap, mid cap, and small cap stocks, as well as domestic and international stocks. Diversifying your portfolio in this way can help spread risk and protect against potential losses in any one particular asset class or security. It can also help smooth out returns over time, as different asset classes tend to perform differently in different market conditions. And with this note on portfolio diversification, we arrive at the end of this video. In the next video, we will discover the dangers of speculative investing and the importance of due diligence. Thanks for watching. If you enjoyed this video, and are looking for more insights and advice on personal finance, investing, self-development, and entrepreneurship books, be sure to check out some of our other recommendations. Check out The Millionaire Next Door by Thomas Stanley and William Danko. This is a personal finance book based on research and interviews with over 1,000 millionaires in the United States, which challenge common assumptions about wealth building. Also, check out The 7 Habits of Highly Effective People by Stephen Covey. This outstanding book will give you insights in the habits and principles that can help you become more effective and successful in your personal and professional lives. Thanks for watching, and we'll see you in the next video. Adios.